Imagine you're at a massive shopping mall, but instead of buying shoes, you're looking to buy the stores themselves. If you'd picked the right wing of this mall 30 years ago, a tiny $100 investment would be worth nearly $3,000 today. But pick the wrong one, you might have barely cracked $1,000.
Today, we're going to show you why it really matters which basket you choose for your retirement. We're looking at why the U.S. market is an absolute heavyweight champion and how one specific sector could quadruple your money if you have the stomach for it. Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses.
Now, we've already established in this series that equities or stocks are the best way to build long-term wealth. But the US market is huge. To make sense of it, think of these 4 famous indices as different tours of that giant mall. The S&P 500 is the general mall. It tracks the 500 biggest, most successful stores, from grocery chains to banks. If this tour is busy, the whole economy is usually healthy. The NASDAQ is the electronics and tech wing. It doesn't care about groceries, it's all about high tech. The Dow Jones represents the 30 heritage stores. Think of these as the mall's prestigious grandparents, famous, stable, but maybe a bit slower. The Russell 2000 is the mom and pop shop tour. These are 2,000 small independent boutiques. They're the best way to see how local shoppers are doing.
So, which tour gives you the best return? Let's look at the hard numbers since 1995. If you'd put $100 into each and walked away for 30 years, here's what you'd have today. The Russell 2000 grew to about $1,008. The S&P 500 reached $1,470. But the NASDAQ, that $100 turned into $2,977. That's a massive difference. It all comes down to the magic of compounding. The NASDAQ's annual growth was 11.5%, while the S&P 500 was 9%. That extra 2.5% every year for 30 years nearly doubled the final result.
But wait, before you put every penny into tech, you need to know about the tech trap. In the year 2000, people were so desperate for tech stocks that prices became disconnected from reality. When that bubble burst, the NASDAQ lost 80% of its value in just 18 months. Imagine watching $10,000 wither away to $2,000 almost overnight. The NASDAQ wins in the long run, but it requires a very strong stomach for short-term risk.
You might think, shouldn't I diversify abroad? Well, the data is sobering. Over the last 30 years, most foreign markets haven't even come close to the U.S. Germany came closest. It averaged about 8%. The U.K. and France trailed behind at 4% and 5%. Asia was varied, but in general, also around the 3% to 5% mark. Even robust emerging markets like Poland averaged about 7% since 2010. Respectable, but still behind even the U.S. small-cap stores.
U.S. companies are simply machines at generating value and growing faster than almost anywhere else. This generally explains why the P/E ratios of U.S. stocks are so much higher than the rest of the world. People are simply building into the price of those stocks the expectation that returns will grow faster over time. So, what's the message for your portfolio? You don't need to be a professional fund manager to win. You just need to choose your basket, understand the risks, and let the power of compounding do the work. Okay, thanks for listening. Now let's go over to Peer Review Pete for a contrarian view of this content.
Thanks, Kate. 3 quick points. First, you can't buy an index directly. You invest in an ETF or index fund that follows the index, or buy stocks in the same mix as the index. Second, your numbers leave out dividends. S&P 500 investors usually get about 2% extra from dividends, so returns are even higher. This doesn't change your main point. The ratio stays about the same since dividend rates are similar everywhere. U.S. stocks, especially tech, still win. Just keep in mind these numbers are rough estimates. Thirdly, remember, the numbers are historical. Who knows if the trend will continue in the future? AI is changing things a lot. Will U.S. dominance and returning continuous growth continue? Only the investor can judge that. Most importantly, these numbers show long-term results. U.S. markets can swing up and down quickly, so in the short term, an investor might prefer the S&P 500 to the more volatile NASDAQ. Finally, you didn't mention that European and global indices usually drop when U.S. prices do, so they're not great for hedging or as safe havens. However, I agree with what you said. U.S. stocks, especially the cutting-edge tech sector, are hands down the world's most powerful engine for building wealth.
Thanks, Pete, and thank you for listening. We've covered a lot of ground today, but this is only one of 30 critical topics every serious investor should master. I highly recommend picking up our comprehensive guide on Amazon. It consolidates the best insights from our first 30 videos into one high-level manual. The link is in the description below, and I'll see you in one of the next videos in this series, which include market crashes and the AI boom. So subscribe so as not to miss out. Goodbye.